cut across to the 8th IAIP annual forecast. A whole host of top voices from mutual fund industry and equity industry are present there, along with Nikunj, Dalmia. Let's cut across.
Which should help consumption. Consumption has been pretty stable in India, but last year we saw that getting impacted. We could see some revival over there. And I would say that there are a couple of stock-specific issues which were there last year. Like, for example, in the pharmaceutical sector, a lot of the large pharma names like Sun Pharma and Lupin, for example, had US FDA issues which had a cut in earnings. So if you take in all these factors and assume a very normal kind of outlook next year in terms of overall GDP growth, the base itself is very supportive. And purely from a bottom-up analysis, when we sat down with our team a couple of weeks back and tried to be very conservative and not being too optimistic, we still came out with a 15% kind of a growth, which people might question, okay, how does it look? Because every year we come with that number and reality is much better. But if you look at all these factors and then analyze, then I think the probability of that growth coming in next year looks to be pretty high.
Sunil, the glass half empty argument, I guess, is out in the public, whether it is China or risks to global growth. Why don't you pour in the full drink? What is the glass half full approach? I mean, what is the good news for FY17?
See, number one is, as an equity investor, I would like to be optimistic.
But it's time to be realistic also, right?
No, so I think the point of
optimistic.
So I'll give you my perspective. So one is obviously when you are looking at investment, you look at it with some hypothesis. So the hypothesis is very clear that India has grown to $2 trillion and India is going to $4 trillion. So I think that is the key hypothesis. Now, an optimistic person like me will believe that this will happen in 6-7 years. Someone who is not as optimistic will believe that it might happen in 8-9 years. What has happened last year obviously has come as a disappointment, and we have to also admit that it was a year full of challenges. So we had two back-to-back monsoon failures. We all felt, believed, and we have two strategists and economists here, that low inflation was good, but in fact it turned out to be not that good. We all believe that oil price falling is good for us, but it is good till a particular level, and then it definitely impacts the global economy and the global growth, and we also got impacted. And on back of it, we also had a very uncertain scenario related to China and some of the other large countries. I think earnings are a derivation of all these. One additional thing is that this government has been working very hard, and there has been some cleaning of the system. So once the cleaning up starts, I think the initial maybe 1 or 2 years are tough years. The cash economy takes a back seat. You have some sectors, some industries, some corporates who get impacted with sudden tightening of the system, and I think that is also what we are seeing. But as we speak, a lot of these things have started to now get reflected in positive vibes, positive news flows. So if you have cement production which is up 14% in February, if you have refinery productions up, consumption of oil products increasing, to some extent selectively capital good companies also starting to see awarding of a lot of new orders. So I think these are all signs that finally, maybe what we expected 1 year back is starting to play out. It might have got delayed, but definitely it's there to play. So I think we are quite optimistic, and we all expected earnings to grow, and it did not grow. Now no one expects earnings to grow. Maybe it is possible that earnings might finally start to grow.
But that's your nature, Sunil. I mean, you're always optimistic. Frankly, from last 10 years, I've never heard you bearish or cautious.
I think that has helped. So the country from 1947 zero to 1997 to 2007 reached $1 trillion in economy. From 2007 to 2014, which was a very bad period for global markets, you had Lehman and you had this and that, still our economy became from $1 trillion to $2 trillion. Equity investors have still made money even in that point of time. And even if you take some negative returns of last year, where investors maybe have lost 7-8%, I think on a 3-year basis, equity still stands to be the best performing asset class. So I think it pays to be optimistic. And my call is very clear that we as Indians have all our savings in India. If you invest in a fixed deposit and the bank lends it to a corporate and the corporate defaults, then you're not going to get your fixed deposit also back. And for the corporate to repay to the bank, they will have to make more than the FD rates. Right. So it is better to be invested in that corporate rather than to be invested in that thing. So
I have some data I can challenge what Nifty has done in the last 5 years, but I'm not getting there. We'll argue that data some other time. The bankers have to be realistic. It's important to be optimistic, but it's important to be realistic. I get a sense that when we started FY16, and again, we all have benefit of hindsight. FY16, when we started, there was a lot of hope, there was a lot of hype. Now, would you say assumptions are realistic?
I think there has been a definite correction in the sort of expectation graph that generally we've looked at when looking at the economy as a whole. But clearly there is a lot of positives that is playing out, be it through the mechanics of monetary policy, where we are seeing a lot of gradual steps towards bringing down the interest rates and the term structure as a whole, be it in terms of facilitating a lot of, or rather clearing a lot of hurdles and roadblocks that have been there earlier, in terms of opening up for corporates space for them to be able to raise cheapest form of liabilities for their for their consumption, for their balance sheet purposes. So overall, on the banking side, yes, there have been issues around of late on the on the NPLs, on the non-performance assets and stressed assets. But clearly, the whole exercise that's getting done, pushed by the Reserve Bank, blessed by the Government of India, is, in my mind, in another 2 quarters, lead to a very healthy, sort of overall banking balance sheet in the country, and that should then be a pretty decent engine to start supporting the economic growth that's been sort of talked about and expected
so
for this year.
So according to you, the NPA concerns are still not over, because, or you expect that will filter to FY17 as well?
Difficult to say, because it depends on what pace each and every individual bank has taken. I guess the process of recognizing what is stressed has been largely completed, but the process of then providing for it is going to be a gradual path. So that you could expect should take another couple of quarters to start sort of impact, or to continue to impact results. But beyond that, balance sheet should be pretty strong after that.
So now, let's be real, interest rates have come down, and they've come down, some would argue that slightly more than what the general consensus estimate was. Yet transmission is not happening, yet credit offtake has not picked up. So the key assumption which everyone had or has, that interest rates will come down and economic activity will pick up, that very basic assumption has got challenged.
I mean, that's true. So there are 2 aspects here. One is, why transmission hasn't happened, and second is why, economic growth hasn't picked up. And the 2 are partly linked, partly there are other factors at work. Other factors at work, and I mean particularly global factors. If you look at a simple correlation between domestic investment cycle and global growth over the last 20 years, the correlation is as high as 0.8, 0.9. So I think, this idea of decoupling is just a sham. So, I think that's been one of the key reasons why things have been weaker than expected. But on your question of transmission, I think 2 things have happened. One is that while the Reserve Bank has been cutting interest rates, liquidity and at least, sort of the daily liquidity requirements of the banking system actually have been quite high. And the Reserve Bank has been supplying that liquidity through its overnight window, term repo window. But the total, on a daily basis, for instance, 2-3 days back, banks were borrowing almost 2.5 lakh crores. And therefore, from banks' perspective, the cost of borrowing because of tighter liquidity did not really come down as much. And obviously they had also taken very high cost deposits in the last 2-3 years, which is going to take time to really bring down the average cost of capital. So I think that's been, one important reason why transmission hasn't happened. Small savings rate has also been blamed, but I don't think that's a very big reason. But I think tighter liquidity is one of the big factors.
What is your basic assumption for a rate cut in FY17?
Well, we do have, the RBI policy next Tuesday, and since the government did surprise us with 3.5 on the fiscal front, we think the Reserve Bank will follow through with a 25 basis point rate cut. Now, the thing is that we have to look at 6.5% repo rate from where we are coming down, which is, from 8 to 6.5. We have now seen 150 basis point rate cut. And in the last 12 to 18 months, while interest rates have come down, if you look at core inflation in India, actually it's been fairly sticky at 520, 540. And there are multiple reasons for that. I won't go into that. So, but I think the fact that, domestic inflation in services been quite sticky at a time where certain global factors are turning on the other side, particularly commodities, would suggest that we are getting closer to the fag end of the cutting cycle. I think the big focus now from central bank perspective is going to be more how to ensure greater transmission of what has already been delivered, whether it's through the marginal cost lending rate mechanism or better liquidity provision, but transmission is really going to be the big focus now.
Neelkanth, to your mind, how far are we away from a real uptick in the economic cycle? Because the capacity utilization in some of the key sectors is still at a low. I mean, there is a pickup which is there, but 65 to 75% is the average number which I'm getting when I speak to corporates right now, which means demand is not there and capacity utilization is yet to pick up. So is economic growth at least a distance away?
No, economic growth is happening as we speak. And I think as Sunil was saying that you can't have 14% cement volume growth. You can't have 12% oil volume growth. You can't have 27% growth in bitumen. That means roads are being built. You can't have 15-16% personal vehicles growth. You can't have commercial vehicle growth at 20% plus sustained over 18-24 months. All of that shows that growth is happening. In fact, perhaps adding on to the responses to your earlier questions, I think the sentiment is so bad that when a positive thing stares you in the face, you want to ascribe negative reasons to it, right? So even some simple things like, say, the currency in circulation has grown by about 16%, right? So year on year it's 16%. Now everyone wants to ascribe negative aspects, demonetization, people are going out of the banking system. The simple fact is that if you plot the last 50 years of currency in circulation growth, for the last 4 years we were running much below the average. Now we've caught up to average. That's it. And in fact, if you see the point at which currency in circulation growth picks up and deposit growth is a lagging indicator, in the last 20 years there have been 3 signs. So late 98, if you remember, after the Russian crisis, the Pokhran blast, and Indian economy was coming out of very weak growth. 2003-04, after the SARS crisis, we saw those are the times when currency in circulation has actually picked up, and I think in 2010-11, right? So these are strong indicators that actually the economy is picking up. And see, India, the M0 to M3, or so let's say the currency in circulation to deposits in the banking system, that ratio, India is 18%, Sweden is at 2%, right? So we are a very large informal economy, and I think the demand for currency suggests that the informal economy is actually doing very well. And the reason it's doing well is all the changes at the state government level, all the changes that are happening in terms of electrification, bank account creation, all the things are actually driving good economic growth. And that's also, I'm surprised when I hear that, it's almost like, unless the 2 companies in the Sensex which are linked to capital goods, unless their order growth picks up, India cannot do well. That's complete hogwash. And I think it is, the Indian economy is actually doing very well, I think.
So we are in that phase, I guess, where markets ignoring good news, yes. They're making an excuse, and whenever there is bad news, it's getting multiplied.
Exactly. So, and the reason for that is people take cues from the market. So I call it, there was an op-ed I wrote in the Express called Lies in the Sensex. So because the Sensex has not done well, the economy must be doing badly, which is, I think, completely wrong.
I'm surprised you didn't say blame media for it.
I would have, if you were not around.
Mahesh, a huge tailwind, and that was an unimaginable tailwind which we got last year, was that vertical decline in crude. That's not going to happen again. That's like in jackpot. Now we can talk about the financial implications, we can talk about the maths and arithmetic, but let's be real. Commodity prices, if at all they will go only higher, and they will inch higher in FY17. That changes a very basic approach. That changes a very basic assumption.
Yeah, so I think last year we got a big bounty because of the oil prices going down. But that whole of the benefit wasn't really transmitted down to the end consumer. Okay, it was taken up by the government by increase in the taxes, excise duty. So that money went actually into creating infrastructure. So if you look at government spending last year, has seen a significant increase. And the benefit of that will come through. I mean, building roads, investment into railways, urban transportation, irrigation. So all those things will happen over a period of time. So I think, I mean, our view is that oil prices, what we saw last year, probably will bounce back a bit, but they're not going to really go out of the roof, because there is a demand destruction. Global economy is going to grow slower than what it grew last year. Yeah, supply side issues can change a bit. So in that kind of environment, I don't think there is an upside risk that oil prices would move up. If they move up, say around $50, $55, I don't think things are going to change materially. Even from the budget standpoint, I think the assumption for crude oil is around $45 or so. We are still below that level. So there is enough room over there to really take care of that.
Sunil, when I was walking up to the hall, you know, my head of research whispered me in my ear, sir, macro sab theek hai, Sunil Singhania se pata karo le kya raha hai. How are you investing in this market?
But I think you are so negative. Why do you want to know what I'm buying?
You know, I love to ask questions. I'm paid to ask questions, so I always love to be the devil's advocate. I guess I'm the only one here who's paid to ask questions.
I'll just give a perspective. You know, I think this discussion for the last 20-25 minutes has been all on negative questions, and I think that is the problem with all investors. So, in the best times and in the worst times, people always find an excuse to be negative. So when oil was 140, people used to say 140 mar gaye. Now in oil is at 30, people say 30 mar gaye. You know, life cannot be a linear thing. But having said that, you know, our view is that obviously, you know, we are in India. I love India. I'm passionate about India. And I think India has a lot of potential. Obviously, there are a lot of things which we need to do right to unlock the potential. But finally, at least on the strategic, structural front, a lot of things are being set right. You know.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.